Good morning, everyone. Welcome to Phillip Securities Research Morning Call. For today, we have the recap of the Singapore SSP third quarter 2026, the recap of what we presented last Saturday. And please note for today, Paul is away for meetings. And so hence so that we can't probably take up some questions that is related to his coverage. This is our usual disclaimer. Please note that this webinar is solely for education purposes only. Please refer to your financial advisor before making any investment decision. So without further ado, I will hand over to Zain to start the recap of the Singapore third quarter strategy. And over to you, Zain.
Thanks, Fahmi. Good morning, everyone. So for our third quarter Singapore strategy, we think that AI is booming and we are not seeing a bubble. Next slide, please. Yeah, so in terms of our agenda, we'll be going through our technical outlook and then our team, followed by some of the sectors like banks, like REITs, and then also update on the other sectors. And also, last but not least, our absolute time model portfolio and a summary of the session. Next slide. Okay, so first we go through the technical outlook for the Singapore market. So first one, this is a chart of the ES3 ETF. So if you are looking to get exposure to the blue chips and the large caps, I think this is the ETF to look at. So in terms of the chart, I think the key point is that it broke out of this sideways consolidation that we saw in the first quarter this year. So overall, it has been doing well with 9 consecutive quarters of gains. In the second quarter, it was up 8%. And recently, in the middle of May, there was a breakout of this sideways consolidation resistance at $5.05. And overall chart in terms of the weekly, it has still been holding the key hour support line since August last year, and also the 20 simple moving average on the weekly, which is the yellow line you see in the chart. So overall, a very steady uptrend, and we do see a potential for further upside to hit about $5.52 in the third quarter. So that's about 161.8% Fibonacci extension level. If you use the swing low formed in March this year and then a swing high in the start of April afterwards. Yeah, so that's about 3.5% upside from Friday's close. Next slide. Okay, next one in terms of the small mid caps, we'll be looking at the next 50 index. So this index actually tracks the next 50 largest market cap companies outside of the blue chips. So in terms of the overall direction, we think that it's likely to move a bit more sideways in the third quarter. It's still done pretty well in the second quarter with a 4.6% rebound. And then, however, we've seen a bit of some slight weakness in terms of the price action from middle of May, where price pulled back from the key trendline resistance. And then it transitioned towards a range consolidation between 1,479 to 1,546 points, this area. So we do see some sideways consolidation in the third quarter with a potential retest of this 1,546 level. That will be about a 1.6% upside from Friday's levels. Next slide. Next one, in terms of our large cap pick based on the technicals, we think that the chart for SGX still looks very bullish and there's some room for further upside. So in general, currently what we are seeing right now is a bullish flat consolidation in an overall uptrend. So the price is trading in this along an upper support line since middle of March, which is the blue color line, uptrend line you see in the chart. And some positive developments was that there was a breakout of this 2160 resistance level in June, and subsequently had a support during a back test. And afterwards, we saw price did quite a bit of a rally in June, and then it's moving in a bullish flat consolidation between 2360 to about 2450 afterwards. So a potential target could be this $27.36 level. That's close to 14% upside from Friday's level. If you use the height of the bullish flag, which is $2.86 projected onto the 2450 breakout level. Next slide. Then in terms of our mid-cap pick based on the technicals, we think that PC partners are still in a steady uptrend and we could possibly see some further upside. if the uptrend continues. So in general, it has been trending with higher highs and higher lows in this uptrend channel since April this year. And recently, there was this breakout, the $2.72 resistance in the second half of June that subsequently held as support. So we do see a potential for the upside, for the uptrend to continue to actually perhaps test $3.48, close to 27% upside, which is this 127.2% Fibonacci extension level. If you use the swing low in middle of May and then the swing high at the start of June. Yeah, so that will retest the uptrend channel resistance area again as well. So that's all from me in terms of the technical outlook. I'll hand over the time to the next presenter. Thanks.
Hey, thanks, Zain. Yeah. So I'll be covering for Paul. He's not around. So any Q&A, just to clarify now that we will try to answer. But if any Q&A that is regarding his queries, then we will either put it into the community P3, the app. Yeah, and then he'll cover it there. Yeah, so just to start off, the theme that we have is booming, not bubbling. So we're seeing, AI adoption is tracking this sort of a logistic S curve, not really a linear growth. Meaning adoption rates are actually scaling rapidly, at 100% to 300%. And then this hyper adoption is the catalyst that we see for massive resource intensive global center rollouts. So next slide. Yeah, the source of growth for this S curve LM adoption, frontier models. So we're looking at OpenAI, Anthropic, Grok, Gemini. These are all models that we are all very familiar with, and I think most of us also use it in our daily lives. These are the primary revenue generators, and they are driving an estimated $1 trillion in data center capital expenditures. So this capex will then be spent directly into the semicon supply chain. And this is how we are actually seeing it, is that we are seeing this 90% surge in global sales, and also quite big profit expansions for memory and foundry players. So we're looking at all these players that will benefit from this. The river source, which is what we're calling it, right, are these LLMs. So they act as the source for all downstream tech spending, right? The top, where the glacier melts, right? So that's where the source is coming from. So any disruption to their growth, this is the key risk here, will severely impact the broader semicon and equity markets. So these upcoming IPOs, right, from major AI labs like OpenAI and Anthropic, these two are the ones that are coming out soon, will be critical milestones that we are monitoring, and for everyone that is watching the space or even in equity markets to monitor. So they will provide the essential and also some visibility, because currently we don't have much visibility into their earnings, right? Their true earnings and their profits as well. And this will give us this visibility into the actual growth rates that we can better forecast, and then this will lead down the line as well to all the semicon players and the foundry kit players as well. So the next slide, you can see that there is a bit of worry, that this is a bubble, right? So the .com valuations, during that time, crossed around 50 times PE. And the current AI valuations, we use Nvidia here as an example, does not really exhibit this extreme euphoria that we have seen during the .com bubble. So for a good comparison, we put in Cisco, right? So Cisco's PE ratio expanded all the way from 20 times, right, all the way to 50 times, and then it even peaked at 100 to 200 times during the .com bubble era. Whereas the current AI leaders, right, Nvidia, for example, is still trading at around 20 times. So we believe that this is a more reasonable multiple range. Not saying that, of course, we don't believe, we're not trying to say that there's no chance of it reaching those levels. But from what we are seeing, and based on history, is that it's still nowhere near to that bubble era that we saw in the 2000s. Moving on to the next slide. Yeah, we believe that the price action is not similar to the speculative froth that we saw before. So the Nasdaq price action did lack that aggressive, spectacular blowout stage that was characteristic of the late 90s and 2000s tech bubble. So the current market performance is really backed by tangible fundamental earnings growth. So for example, we use Micron here, is generating 12 times earnings growth, rather than pure speculation. So to take away from this is that a lot of the tech companies now, they are growing, right? They do have good fundamentals, and they are actually, not just selling a pipe dream. Yeah, for the pipe dream wise, if you know my stance, it's a bit on like Tesla. So that's where the pipe dream is, where there's nothing really fundamental backing the share price movement. Now moving on to the next slide, I think the last slide for the macro sector, we're looking at the corporate profile. So the US domestic economy is demonstrating quite strong momentum, and this is really signaled by the outperformance of the Russell 2000 index relative to the Nasdaq. The core retail sales have also, which we exclude auto and gas, have also hit 3-year highs. Payroll quality is also improving, right? With job creation is accelerating the economically sensitive private sectors. So not just the government and healthcare hiring, we're looking at a private sector that is also growing. So we believe that that the economy in the US, right, is gaining quite a lot of strength. Next slide. Yeah, so we're moving to the Singapore banking. So we do have two focus areas, right? This is, I guess, the biggest sectors in the STI as well, the banking sector, and then later on Darren will cover the REIT sector. So for the banking sector, we are looking at rates, returns, and resilience, basically the 3 Rs. And the next slide, we'll see what we mean by that. So for this, it's the rates, it's the NIM compression, right? We're looking at the interest rates and how does it affect margins. So we believe it's at the tail end. We are seeing FY26, we're predicting that it will be down by, it will still be compressed, right, by 17 basis points. So this figure might seem a bit high because the previous year it was about 20 plus, still double digit kind of compression, but we believe that this is the tail end. And so for the following year in 2027, we are expecting it to be much smaller at only around 4 to 5 basis points kind of compression. What is sort of we base this on the SORA uptick that we are seeing. So in June, we saw SORA finally inch up by 1 basis points, and we also saw records CASA ratio and also post-COVID high loans growth, and this all helps to cushion the net interest income and help to offset that margin compression. So net interest income, was only down by mid-single digit, although for the first quarter, but margins has continued to compress by almost close by double digits for all 3 banks. The other R is returns. So what will be generating the returns of the banks, and that will be the fee income. We are seeing fee income grow, by double-digit growth for 2 out of the 3 banks, and also the fee income share has been climbing. So the banks are shifting away from very rate-dependent income, which is net interest income, into fee income, which is less rate dependent and more, I guess, based on how much they want to expand on their RMs and to grow, to aggressively push for fee income. This is also the most capital light earnings, which will help to fund the buybacks and dividends. And we expect that FY26 PATMI will increase by an average of 8% year on year across the 3 banks. And last but not least, resilience. For resilience, we prefer DBS, which has the highest fee share and also the highest dividend payout ratio, and DPS. We'll go more into detail for DBS later, and also OCBC for the fastest fee growth and also the special dividend upside. Next slide. Yeah, several charts on why we believe the 3 Rs. So the first one is that loans growth has hit new highs. We saw May 2026 loans growth. This is MAS data, by the way. So not the bank's loans growth, but overall in Singapore, what's our loans growth figure? And for May, it was a very healthy 8.7%. This is the highest that we have seen it, since MAS changed the way of calculating what is loans growth, and also I think post-COVID, this is the highest that we have seen it. Year to date is also still very healthy, above 7%. And the interesting thing is that the bank's guidance in the first quarter was still maintained. They didn't change that loans growth guidance, right? It's still guiding for low to mid-single digit. And from what we are seeing from MAS data, I think there is an upside in guidance, and we could probably see them pushing it up to mid-single digit or even high single digit loans growth guidance for FY26. I think what's holding them back now would be the second order and third order impact from the Middle East conflict, right, and the volatility. So that could be holding them back from actually increasing their loans growth guidance. But we could see some, if they manage to properly settle, where does that impact actually land? Because from what we are seeing is that it's not a very big impact. Next slide. Yeah, so the other factor that we're looking at, is helping, before this, that is helping the banks perform better and also, maintain their net interest income would be the deposits, right? And this is really helping the banks fund the loan boom. So deposit growth has recovered in the last 3 months. It's all above or around 7%, mainly from the safe haven inflows amid the Middle East tensions and also market volatility. And on top of that, we also have wealth AUM growth, which is helping to drive the deposits. And more importantly, the CASA ratio has continued to expand. So we're seeing it the highest since October of 2022. May was at 20.7%. Why this is important is because CASA or current account savings accounts is the lowest cost of fund for the banks, right? So the higher the CASA ratio, it will mean lower cost of funds, and then it will flow all the way down to improve margins for the banks. And on top of that, they are using this higher CASA, higher deposits to fund that loans growth that we saw in the previous slide. Yeah, next slide, please. Yeah, so we have two stock picks, our preferred stocks, but for the banking stocks. The first one, that I think we have preferred amongst the three banks, the top pick will be DBS because they tick all the right boxes, right? There is 3+1 boxes that we have for DBS. The three boxes, the first one is their guidance is they upgraded the guidance. So the only bank that did upgrade the guidance, right? They raised it to FY26 total income to be around FY25 levels. Previously, they said that their net profit will be slightly lower. So this is a good and strong guidance upgrade. The second box that they tick is that they have a quarter-on-quarter NIM stabilization. And then the third box is that they have double-digit fee income growth. So you look at these two boxes, you'll be thinking, oh, doesn't UOB and OCBC have this as well? Yeah, they do, but they only have one or the other, right? So DBS is really the only bank that has both of these combined. OCBC has the double-digit fee income growth, but their NIMs quarter-on-quarter is looking quite weak. And then UOB has the NIM stabilization quarter-on-quarter, but if you look at their fee income growth, it's actually declined, right? So that's why we like DBS, because they have all these three boxes. And on top of that, the fourth box, which is that the dividend payout ratio is the most stable and the most secure, and also the highest amongst the three banks. They're really the only bank that is willing to forecast their dividends and give an absolute dividend payout, not based on earnings. So, it's not on this like arbitrary rule of 50% of my earnings, right? They're saying we have enough capital, we're going to give it back to you. So we are able to better forecast what is the dividend yield you'll be getting, which is for DBS around 5% now, even at their current share price. Yeah, next slide, please. So for OCBC, we do also like OCBC. The main reason is that they have the highest fee income growth. So now when you're looking at a bank, we would prefer a bank that has a bit less rate dependent, right? Because we're not very sure where rates are going to be, and rates are already so low, right? So shift away from that net interest income into something that's less fee dependent, interest rate dependent, like fee income will be a positive. And OCBC has the highest fee income growth amongst the banks. And furthermore, they are finally spending their excess capital, right? So they are spending it on the HSBC Indonesia acquisition. This will help to further supplement their wealth management growth. And last but not least, there's also a possibility of a special dividend if the share buyback that they have about 700 million plus is not completed by this year. But for OCBC, you realize that we do have a neutral call, and why we are not having an accumulate for this is because their NIMs and margins are still quite volatile, and I think they are still seeing, even quarter-on-quarter basis, right, while rates have stabilized, they're actually seeing close to double-digit kind of margin decline for quarter-on-quarter for OCBC. Yeah, next slide. Yeah, I think that's all I have for the banking sector. I'll now hand it over to Darren, who will cover the REITs. Thanks.
Yeah, thanks, Glenn. Yeah, let me run through the outlook for REITs. So for REITs, we believe there are opportunities despite rising interest rate environment. Like just to recap, so far this year, Reserve Bank of Australia already raised rates 3 times. Bank of Japan also raised rates once. So did the ECB. So global rates are likely to stay elevated or even increase. Like the Fed is potentially also going to raise rates later this year. Yeah, so despite all of that, we still think there are selective opportunities that remain. So we favor those with a high hedge ratio because as interest rates continue to, or rather likely to start increasing, those with high hedge ratio can be more insulated from this rising costs. And those with, of course, rental income that are more resilient. So those that can grow their income from positive rent reversions as well as the base rental escalations. So these are some of the REITs that we favor. Next slide, please. Yeah, so looking at this table over here, so this shows in the past few years or since COVID, some of the subsectors as well as the geographies that have been performing the weakest in the S-REIT sector. So, or rather the S-REIT universe. So some of these mentioned here are US office, Chinese office, and such. So this is just a historical look or historical recount of what happened over the past few years and whether potentially these sectors are on the road to recovery. So from our perspective, we believe the US office has really bottomed out. So recovery is really underway. It's driven by high recovery is driven by high quality assets. So the older buildings will likely continue to face leasing challenges. So the location also and the sub-markets are very important. So assets where they are more well located and some assets in some belt cities also perform better, like those with core and prime. Yeah, and for supply wise also is very limited because since COVID, as construction costs rise and demand fell from basically from home trends, there were very few ground breaks and new supply incoming. So now the demand supply dynamic starting to look more favorable. So we think the US office has bottomed and is starting on its road to recovery. For China business parks and office, corporate demand still remains weak, and there is also oversupply situation, and we do expect the rental reversions for China business parks and office to remain quite weak in the low double-digit negative. So, CLCT has some about 20% exposure there. For China logistics also, it has recovered over the past few quarters. So previously we are seeing double-digit negative reversions, but it's now narrowed to about -2% for MRT. So that's MRT is just a sort of a proxy for this sector. So going forward, we do expect it to turn possibly flat over the next few quarters as the market rents has already been got marked to market at the lower rate. So rental reversions are likely to be flat going forward for the next few quarters. China retail also similar to China logistics. The Chinese consumer sentiment has not been strong. Retail spending has turned negative in May. So, but we still see the tenant sales for some of these REITs like CLCT have a 5% increase in tenant sales. Despite that increase in tenant sales, we are still seeing a slight negative rental reversions. So we think that's likely to remain at least in the near term. So going forward, we are looking at possibly low to slight negative reversions for both China logistics and China retail. For Australia office, we've seen a recovery in some markets like Sydney. Sydney is a strong market. Melbourne and Adelaide continues to face some challenges as their vacancies are about 20% and tenant incentives also over there remain quite high, 40 to 50%. Sydney tenant incentives has improved, so now it's around 30%. So yeah, the recovery is also bifurcated and differs among the markets. Yeah, so Suntec REIT has some exposure to the Australia sector, and the share price for Suntec REIT has really performed well, and it's mainly driven by the Singapore very resilient performance for the Singapore assets. Yeah, so this is just a broad overview of what happened in the past and our take on the outlook and whether there is a room for recovery. Yeah, next slide, please. Yeah, so moving on to our stock picks. So we still favor Stoneweg Euro Stapled Trust as our top pick. It's mainly because of its attractive yield. So 8.5% yield despite the recent increase in share price. So I think that's very attractive. So if you look at this yield spread, which is the dividend yield of Stoneweg minus the 2-year German bond yield, now it's at 6.5%. If you look at absolute terms, 6.5% yield spread is very high indeed. But if you look at this chart, it's at -1 times around -1 standard deviations from the mean, which doesn't really look that attractive historically, but you have to take into account that from mid 2022 and before, so before 2022, basically the German bond yield was at negative. So it's basically below zero. So let's say if I use 10%, then the German bond yield is negative 0.5. So your yield spread is actually like 10.5. So because of that, the yield spread is kind of looks a bit is skewed higher towards the back before 2022. But now considering that the German bond yield has risen to about 2.5%, we are still looking at about a 6.5% dividend yield. So we think that's really, really attractive. And for the rate impact of the rate hikes on Stoneweg Europe Staples Trust, so that there's a minor headwind. But for them, they have 87% of their interest exposure hedged until end 2027. So we are going to expect minimal impact from any ECB rate hikes. So in the first quarter, they had 3.84% cost of debt. So we think the cost of debt for this year will remain below 4%, despite the ECB rate hike, mainly because of the high interest hedge exposure. And for their portfolio valuations, it's the fifth consecutive increase, a half-year increase in their portfolio valuations. So this first half is up 1.1%, mainly led by the light industrial and logistics sector. And we do expect significant upside potential from their stake in Ionics. So Ionics is their data center development platform. So as that get built up and the more leases get signed, we do expect some meaningful uplift in valuations at their stake in Ionics. And organic growth wise, we are expecting mid-single digit rent reversions for Stoneweg, supported by their portfolio being 7% under rented, and their portfolio is also CPI indexed, which means the rent escalation is based on CPI. So yeah, they continue to benefit from that as well. Yeah, so we think that is a very attractive yield for Stoneweg, 8.5%. Yeah, next slide, please. Yeah, next we have Prime US REIT. So for Prime US REIT, we think there is a lot of potential to unlock the value, the deep value discount for Prime US REIT. Look at the price to NAV. Like 2021 was trading at about 1 times price to NAV, and now it's trading at 0.3 times. So the price of Prime US REIT has really been sold down. But we think going forward there is a lot of room for capital appreciation. So first of all, because 11% of the occupancy is to commence cash, so that what that means is only about 72% of their portfolio is contributing cash contributions for now. So and even with that 72%, we are expecting a 7% yield. So as more of these longer leases start to contribute cash for the portfolio, then the distributable income will spike. So we do expect a 30% spike in distributable income in FY 2027, which is next year, and that will really increase the DPU yield. And the occupancy, we do expect to continue to recover. So in the first quarter of 2026, it was at 83%. So it has been steadily increasing over the past few quarters, and we do expect it to reach at least 85% by end of 2026 with strong leasing momentum. And currently, their payout ratio is at 65%. We do expect them to increase over time as more of these cash contributions start to come in. Yeah, so for our perspective, why we think Prime isn't performing that great in the share price is because this income has really yet to flow into the portfolio, and also because of the interest rate headwinds. The market is pricing in rate hikes, so it's that definitely impacts the sentiment for Prime US REIT as they will be directly impacted. But for now, even if with these interest rate headwinds, we're looking at some of the numbers. Yeah, it's trading just too cheap. So we think sentiment will start to improve as these contribution from these cash contributions start to come in into the DI, and as a result, the dividends will increase. So we think then the share price the sentiment will change rather. Will turn for the better. Yeah. So that's for Prime US REIT. Next slide, please. Yeah, so now this is a sector update. So the sentiment has really been very volatile for Singapore. So it's also very similar to the US where the sentiment is really extremely volatile, where we see one day the share price can be up 10% and the next day it can be down 10%. So this is considered quite rare in Singapore. Yeah, so now we'll just run through some of the sectors that we cover. Yeah, so for property, the affordability is still is still quite affordable for to buy private residential as we've shown in the previous during our SSP that the affordability now is around 14 to 15 times, so that is around the historical number. So what this affordability is basically the prices of condominiums divided by the annual income. So it's around historical level. So we think, not we think, basically it is still quite affordable for Singapore residents to purchase private residential properties. So we still think demand will remain quite resilient for residential developments. Yeah, so for property, we have some recommendations. So for CDL, they're undergoing a strategic review. So we do expect more asset divestments once this outcome of the strategic review, there's more news on that. And for them, they have about 1,300 units that are slated for launch in Singapore over the next year. So that excludes the Tanjong Rhu site. So if you include that, that will be another about 500 plus units. So that will bring their total units to about 1,800 for in the pipeline. But at least by the first quarter of 2026, we're looking at 1,300 units. So they still have a strong pipeline. So this is similar to what we've seen over the past few years, where the pipeline every year is about 1,500 units. And for CLI, we still like CLI for their asset-light model, as well as their recurring fee income business. So their FUM has increased. So it was 118 the previous year, and now it's risen to 125 billion. And also their plans, or rather they are in the final stages of listing their second China C REIT. So this provides another avenue for them to recycle their Chinese assets from the balance sheet, which has not been performing too great, as China continues to be weak, like I mentioned in the REIT slides. Yeah, and for PropNext, so this is covered by Paul. So he has an accumulate call. So the pipeline of launches this year is slightly lower than last year. Last year we saw over 11,000 units launched. This year we are looking at about 8,000, 9,000 units, so slightly lower. This year the launches are largely in the OCR, but at least for PropNext, we do not see any risk of intervention, as the property price index the increase has been quite benign. So it's up about 0.5% this quarter. So we are looking at about 3% to 3% growth per year. So this is healthy levels of property price appreciation. So we don't think there will be any significant risk of intervention. Yeah, that's all from me. I'll hand over time to Ekban to run through the construction sector. Thanks.
Yeah, thanks, Darren. This is our construction sector coverage. As you can see in the list of these 6 companies itself, we are quite balanced across the value chain. For example, for the first 2 companies we cover, they are supporting building raw material companies for the construction sector. For the next 2 companies, Weher and Centurion, they are services provider, dormitory, especially for dormitory for the construction sector. And for the last 2, Soybuild and Evergreen, they are contractors. So going to the first 2, BRC Asia and Pan United. For BRC Asia, they have a 60% market share in steel rebar. This year itself, we expect them to benefit from the progress of the construction projects itself, because last year, in terms of the construction contracts awarded itself, it is 60% higher than the historical average of $30 billion. So last year, the contracts awarded was $50 billion. And this year we are seeing the projects being executed. So for example, year to date in April itself, the volume of steel rebar is up 34% year on year. We expect this trend to carry on for the rest of the year. BRC Asia, we also expect a 58% dividend payout ratio for this year itself. So that will yield shareholders about 5%. For Pan United wise, they have a 40% market share in ready-mix concrete, similar story to BRC Asia, because ready-mix concrete is being used in conjunction with steel rebar for the projects itself. So year to date, April itself, we also see ready-mix concrete volumes up 26% year on year. We also expect future contracts coming from HDB BTO expansion, as well as MBS integrated resort extension, as well as the MRT LTA line expansion projects. Next up for WeHer, they have many segments. For example, they have construction segments, they have a worker dormitory segment, they have property investment segments. So within their construction segment itself, we expect the record $673 million order book to support their growth over the next 3 to 4 years. Last year itself, they also have a new 10,000 bed worker dormitory called Pioneer Lodge, which was operational at the end of last year. So this year we are slowly seeing the gradual ramp up of the property itself. For WeHer, we are also seeing a potential catalyst from a possible renewal of their 16,000 bed worker dormitory called Tuasville Dormitory, which has its lease expiry in November this year. So the possible lease extension announcement could come in the coming months. We are confident that the lease could be extended because of the major construction projects ongoing. For example, Changi Airport Terminal 5 and the projects mentioned earlier just now, like the MBS IR extension. So we don't think that the government would leave 16,000 workers stranded without any bids. And because WeHer's Tuasville Dormitory is compliant with the interim dormitory standards as well for 2030, so we do think that their lease could be extended for over the next few years. For Centurion wise, we expect higher property management fees from managing KERIT, which is the REIT that they just spun off last year. And Centurion has also started to deploy their capital. They are slowly entering into Australia key worker accommodation segment. We do think that Centurion has a very good track record in spotting opportunities early. For example, their entry into Australia student accommodations back in 2015, 2016, which has done them well. Which has done well. So we think that Australia key worker accommodation could be the next growth segment for Centurion. For Soybean wise, this year itself, we see the execution of the $648 million PSA supply chain hub project to support their revenue and PATMI growth this year, because the project is expected to be completed the first quarter of 2027. And for Soybean, they are also trading at a deep discount of 46% discount to its peers average PE. This is because investors see a risk of a slowdown in the private sector, because Soybean historically mainly tenders for private sector contracts, and because of the Middle East conflict, there's a slowdown in terms of private sector demand. However, I do think that it is a medium to long-term play, because the Singapore government has increased its budget for the RIE 2030, which is the Research, Innovation and Enterprises budget. And we think that the Singapore government could bring in more semiconductor manufacturing facilities contracts into Singapore, which Soybean has a good track record in. Yeah, so we are still positive in the medium to long term for Soybean. For Everglory wise, after the acquisition of Guthrie last year, they are the biggest M&E player in Singapore. Their order book spiked up over 4.5 times year on year. Now it is $900 million because of order wins from the various M&E contracts. For example, from hospitals, from bus terminal runway, bus terminal, bus depot, and as well as private sector contracts. So going forward, we think that they are also able to secure further contract wins. For example, from the Changi Airport Terminal 5 runway lighting and Integrated General Hospital M&E contracts. So for example, they are trying to tender for the Nok Seng Hospital as well as Tengah Hospital contracts, which for each contract could yield them about $200 million. So it is very substantial. And for Changi Airport Terminal 5 runway lighting, they already had a track record of servicing and maintaining one of the runway for Changi Airport. So we think that they have a high chance of securing the runway lighting contracts for Changi Airport Terminal 5. Yeah, so this is our construction coverage summary. Yeah, next slide, please. Yeah, so moving on to our electronic recommendations. For Franken-wise, we do think that the earnings will consolidate over the next 2 quarters because one of their key customer, ASML, will need this interim time period to prepare as well as qualify for the high-end EUV equipment. However, we do think that over the next 12 months itself, there will be a higher memory spending. So this will drive demand for ASML's high-end EUV machine, which will flow through to Franken's revenue. We do think that there could be a time lag in terms of the revenue recognition. So Franken could benefit from this trend from the fourth quarter of this year or the next year onwards. We also expect a ramp in automotive for Franken because their key customer Gapwave has announced that they will gradually ramp their radar antenna volume in 2027 itself. So we do expect that to benefit Franken. For Valuetronics and Venture, it is covered by Paul. I'll present on behalf. For Valuetronics, we do expect a sluggish earning this year because they have legacy products such as the electric toothbrush as well as shavers. However, they did commit to special dividends of 16 cents Hong Kong dollar, which is a 100% year-on-year increase because of their strong balance sheet. For venture-wise, management guided new shoots this year. We do think that they are beneficiary from the global data center build-up. For example, they supply network interface cards in servers, semiconductor equipment components. And they also have a new consumer lifestyle product coming out in fourth quarter this year, which could provide them additional upside. Yeah, so this is the conclusion of our electronics recommendations. I'll hand over the time to my other colleagues. Yeah, thanks.
Thanks, Iqbal. I'll go through the air transport sector update. So the green and red lines in this chart indicate the capacity and demand for the full service carrier SIA, and the blue and yellow lines indicate Scoot's capacity and demand. So what we observed is that the Hormuz disruption had a much smaller impact on SIA as compared to, say, the COVID-19 pandemic, which was a total supply and demand shock. So the disruption we are looking at is similar to the seasonal dips we see at the start of 2023, 2024, and 2025. So the reason why SIA has had a more resilient demand is for two reasons. First is because they were able to capture the rerouted flights that were bound for Europe. So usually flights that go from Asia to Europe do a stopover in the Middle East. But because of the US-Iran war, these flights were stopping over at Singapore as well as Thailand. So that allowed them to sustain their number of flights. And second, SIA has a strong hedging policy. So SIA does hedging on both crude oil as well as jet fuel. Regional carriers like Cathay Pacific only hedge on crude oil, and your majority of your American airlines do not have any hedging. So this protected them from the jet fuel price increase we saw earlier. Air cargo rates globally, even though capacity is returning to the Gulf, rates are still elevated. It's about 35% higher year on year. And this is despite the US-Iran ceasefire. The reason for this is because customers are choosing to fly their goods now rather than wait a week or a month later where prices might fall. But they do not want to take the risk, and they're paying a certainty premium. And that's what's keeping their demand for air cargo logistics. And lastly, for jet fuel, the prices are down about 26% month on month, but it's still about 30% higher year on year. There is some regional price differences for jet fuel across the region, which is amounting to about $16.6 per barrel. And that's good news for China Aviation Oil trading business. Next slide. So in terms of air transport recommendation, we have a buy on China Aviation Oil, share price $2.53. We believe China Aviation Oil will benefit from the price difference we saw earlier. So, for example, in Latin America, as of last week, jet fuel prices were about $124 per barrel. But in the Middle East, the prices were about $108 per barrel. And this is China Aviation Oil's business structure, where they buy jet fuel for cheap from one region, and then they buy it in bulk. They also get discount on top of the price due to economies of scale, and then they're able to sell it and repackage it for a higher price at another area. So that will be a key earnings driver for them. And secondly, they are Shanghai Pudong International Airport Associate. It's expanding currently. They are building a new terminal, Terminal 3, and this will increase passenger capacity by 63%. So with a larger capacity, there will be more flights that will be flying from there. And that will mean there will be more need for jet fuel, which is a good news for China Aviation Oil. For SIA Engineering, we have a buy at a TP of $4.06. So the underlying structural driver is still intact, which is a delay in a new flight delivery. And SIA Engineering is also building up its key earnings driver, which is their engine JV called Sesel. It's expanding by 40%. And apart from that, there were some issues with a GTF engine due to some contamination, and they were being recalled the past year. And the turnaround time for the maintenance was about 30 days expected, but when they actually did the maintenance, it took them about 300 days per engine. So this is good news for SIA Engineering because they charge on a per hour basis. And we think this can sustain them as a recurring revenue for until 2027. For SIA, we have a neutral at $6.43. Even though operationally they were doing better than other carriers regionally, the drag from Air India is still there, and we think this will continue to affect them going forward. For SETS, we have a buy at $4.52. They do have consistent contract wins in America as well as Europe, both from new customers as well as from existing customers. So the reason why they are winning so many contracts is because of their global nature. After they acquired WFS, they have a global cargo logistics network. So if an existing customer is using them for one location, they are likely to use them for other locations to serve them globally. And that's really driving their new contract wins. So next slide. I'll quickly go through on Ultragreen AI initiation. Ultragreen AI, it's an indocyanine green vial manufacturer. The company IPO'd in December 2025. So what they do, or what the use of ICG is to help surgeons make better decisions during surgery. The way they do it is by taking this ICG vial, which is in a powdered form. They will mix it with water, inject it into your veins, and this green liquid will spread, and the aim of this green liquid is to show you where there is good blood flow and where there is bad blood flow. So if you look at the picture on top, that is without your ICG vial. So this is a colon operation and you cannot tell where there's good blood flow. But when you look at the picture at the bottom, you're able to see shades of green, and these green areas indicate where there is good blood flow. And this can help surgeons make better decisions because they can know exactly where to operate in real time. Investment merit wise, we expect a deeper penetration of ICG across key procedures. ICG is used across a few key procedures, such as breast reconstruction, colectomy, and a few other surgeries. And we expect a deeper penetration across these established procedures because they have already been used, and we expect more hospital operators adopting it because it will become a standard of care. So apart from that, we think a new market will open up for them, which is a breast SLN indication in the US. Currently, they do not have approval to serve their product there, but this is because another company called Novadac has been issuing this product across the US for this particular surgery. Their approval period has ended last month, and if Ultragreen applies for approval, then it's going to take about a year, and we think this is a 60 million market that they can tap into. Second investment merit is the expansion of their business model. They're moving from a consumables to integrated ICG software platform. So the earlier picture we saw, we see shades of green, but we are not able to quantify what percentage of green it is. Perhaps one area might be 80% good blood flow, whereas one might be 70% good blood flow, but we are not able to see that just from the green shade alone. And that's where their Perfusion Works quantification software comes in. It tells you exactly how much blood flow there is. And for this particular software, they're applying for Europe and US approval, and it's expected to be commercially operating from 2027 onwards. Third, they are eyeing for M&A and investment opportunities of about 150 million across their supply chain, which would be able to improve their resilience and potentially reduce their cost of production. Next slide. This is a snapshot of their key products. Like we saw earlier, indocyanine green, the powdered vial, is their main business. And this is where they really want to grow at the moment. But to use this indocyanine green vial, you need an imaging camera because this dye is not visible to the naked eye. This camera is very expensive, about $50,000 to $200,000 per camera. So adoption can be slow, especially in areas like Asia. So what the company is choosing to do is to produce this camera in-house for very cheap. And what they plan to do is to lease it to hospital operators across Asia. So they will be leasing it, say, for $500 per month, and they will bundle your ICG vials together with it. So that's one of their penetration strategies in Asia. The Ultra Green Data Platform, which is their quantification software, it's not generating revenue currently, but that's because they are still awaiting approval. For Europe, we are expecting approval either this month or next month. So after they get Europe approval, they will apply for US approval. And we think this can be a lucrative business for them because they can charge on a subscription basis or they can charge on a per use basis. On a per use basis, they're able to charge about $1,000 to $3,000 per use, which is much higher than their ICG vial, which goes about $130 to $150. So we have a buy on them with a TP of $1.92. Next slide. So the rest of the slides, it's Paul's slides, but he's away at the moment, so I'll go through on his behalf. For Keppel, we have a buy on them at $13.80. There was some share price wobble after the M1 divestment fell through, but we still like the business because they are moving into a more recurrent revenue model. So they're moving from an asset heavy model to one that allows them to manage money for others, so into fund management. And they also have about $2 to $3 billion in planned divestitures for 2026. And they've guided that of these planned divestitures, 10% will be paid out as special dividends. And apart from that, a new earnings driver will be their Keppel Sakra Cogen power plant, which can increase their total earnings, and we are positive on Keppel. For Sembcorp Industries, we have a buy on them at $7. So first half earnings was a bit weak because renewable energy business in India was underperforming. But they are planning to make a $5 billion acquisition in Australia that we expect it to be earnings accretive. Their energy trading margins spread are also improving due to the Middle East conflict. For ST Engineering, we have a buy on them at $13. Their driver is really global defense spending rising, and ST Engineering benefits because they're able to increase their export sales. So what they're targeting or guiding is $11 billion in export opportunities over the next 2 years. So apart from their weapon sales, their MRO, aircraft engine MRO, is also doing well, and we are expecting earnings growth of about 20% for this particular business. Next slide. I'll go through a healthcare recommendation. So Raffles Medical, we have a neutral at $1.02. We believe the company is facing some foreign competition, mainly from Malaysia and Thailand. So these countries, they're able to provide comparable services at a much cheaper rate. And so private hospital tourism in Singapore is on a downtrend. And next, for Q&M Dental, we have a buy on them. at 71 cents. They have about $300 million in pending acquisitions that can raise their earnings per share by 80%. And they're also expanding their franchise across Asia. For Thomson Medical, we have a buy on them at 7 cents. So their Malaysia operations is turning around, and they're also diversifying beyond your OBGYN, obstetrics and gynecology business into other services. But we do expect recovery to be a bit slower than peers. For IX Biopharma, we have a buy at $1. So the big catalyst for them is this emergency use authorization, EUA. So EUA is a fast track approval for certain drugs that's typically reserved during emergencies like the pandemic. But their Wafermin product is applying for EUA approval. So if they get EUA approval, they will be able to sell it directly to the US Department of Defense, which will be a very lucrative business for them. And for their phase 3 trials, the company will be able to pursue trade sale even before the trials end. So they will be generating revenue even before the trial is fully complete. And lastly, they are pushing into a direct-to-consumer sales model in the US for 40 other products. Next slide. Next for telecom, we have accumulate on Singtel at $5.20. We like it, and we think the growth engine will be their move into data centers. Singtel continues to pay a special dividend, partly by monetizing their Bharti Airtel stake, which is worth about 6.8 billion. Next for StarHub, we have a neutral on them, 95 cents. Competition remains intense for them, but the share price has stayed relatively stable, and we think re-rating is possible if there is a potential merger with M1. For Netlink, we have a neutral on them at 96 cents. Netlink is a stable business with a stable yield of about 5.5%. And we think it's attractive in today's low interest rate environment. And this is because lower rates make steady dividend yields more attractive compared to, say, cash. For TeleChoice, we have a buy on them at 33 cents. So they are bidding for a data center project, and we believe they have a good chance of winning it. And they're also riding on U Mobile's growth. Next slide. So next we will touch on our Absolute 10 model portfolio. So we removed Prime US REIT because we think there is more clarity needed on interest rate as well as the pace of the US market recovery. And we replaced Prime US REIT with ST Engineering. The biggest drag to the portfolio was geoenergy. So this was hurt by a regulatory change in Indonesia on coal projects, but this regulation was removed. Apart from that, they have a $190 million road building project, and the company has approached them to buy a stake in that road project, which we think could be an attractive catalyst for them. Next slide. So this is just the historical performance of our model portfolio. The model portfolio was up 5% on the quarter and about 13% for the year. Next slide. So in summary, we believe there is not an AI bubble, but it's actually booming. And we think something to look out for will be a frontier AI model revenue, which is how fast leading AI labs revenues are growing. And if that growth is faltering, then we think the broader AI and semiconductor story will also weaken. So we don't think there's a speculative bubble in valuation. And our favorite sectors are your banks, semiconductor, building material, power, as well as your higher yielding REITs. So I think that's all for us, and we'll move on to questions.
Hey, thanks, Hashim. Yeah. Let me take some of the questions first. You're asking about Tesla. How's Tesla's 2Q deliveries? Why did the shares drop after? Yeah, I think for Tesla, it's because I think it's really priced in, to be honest. And even if you look at, they did such a bad first quarter, and if you look at the second quarter, I guess it's a very big improvement. Let me pull out the numbers here. how well did they do? They did a 25% year-on-year increase in deliveries. So that's very good, very strong, healthy growth. But if you look at the last 12 months, so last 12 months combined, the growth is only 4%. So really quite small. And I think it's really priced in. They're almost more than 200 times PE. People are no longer buying a car company, if you look at it, right? So that's why even though they have such strong delivery numbers, and even their energy storage also, you didn't bring it up here, but energy storage is up by 41%, right? I think partly also due that they sold some of it to SpaceX. Yeah, but energy storage up, deliveries numbers all up. But why the share price drop is because I think there was no new updates on the things that are driving the share price movement, which is the full self-driving, the Optimus robot, all these things, right? They are not what they just announced. Right, so people are no longer buying a car company. Now they're just buying this AI company, and basically Tesla is becoming an AI company now. Yeah. So even though the deliveries are positive, negative also, I don't think anything will move. Even if it's negative, right? And then they come out and say that, oh yeah, we have successfully launched full self-driving in a certain state or country, right? I think the share price will just pop back up. Yeah. So, but our belief, right, why we still have a sell call on Tesla is because these AI deliverables, and whatever they are trying to sell, it won't come into fruition anytime soon. I don't think it'll be in the medium term even, right? Medium term is slightly more possible, maybe 5 years to 10 years kind of time frame where they will be able to sell their robots and full self-driving on a scalable some form of scalability. But for now, right, our target price is usually take to 1 year. Yeah, I doubt we will see it close to coming to any form of fruition. Yeah. Don't get me started on SpaceX. I think that's even worse now. There's also a question on SpaceX. Since I have it here, might as well just talk about it. Yeah. Someone's asking, hi Glenn, are there no more positive force buying catalysts for SpaceX after the 7th of July Nasdaq entry? Yeah, no. Yeah, to put it bluntly, no. I think instead of a positive force buying catalyst, I think there will be some negative force selling catalyst. So the first ones would be I think the biggest one is the staggered insider lockup expirations. Yeah, so they're very, very low flow, around 5%, right? And this really caused that surge, post IPO, because it's such a limited number of shares out there and everybody wants to buy it, right? Because I think remember how many times oversubscribed? Maybe 5 or 10 times oversubscribed. Or is it 20 times? Yeah, but it was like, don't know how many times oversubscribed, and then everybody wanted to buy into this, hype. So a lot of the retail investors, some insti also as well, they just put whatever price, just buy, and this drove up the share price. But once the insider shares, right, start to get released, then more and more goes into the free float, right? Then we could see the price actually start to go down. And these dates are all publicly available. Yeah, so just to be very careful, when you watch out, like you might get hit because suddenly there's a whole bunch of shares that just get released into the market, right? This will flood the supply, and you know how demand and supply works, right? The share price will just crash once this goes in, if the demand isn't there. And I think we are seeing some weakness in the demand now, especially even though the Nasdaq entry went in and everything, but I think if you look at the fundamentals, it's not looking great. It's still losing money. Right? They're selling mostly Grok and XAI now instead of whatever works, which was the space business and the satellite business. Yeah. I think one of the banks. I saw there's one more. Yeah, one on Yangtze Finance. Yeah, Yangtze Finance not doing well. They haven't been doing well for many, many years. Especially after the Yangtze Maritime listed, right? And and moved out of Tiangang Finance, I think they're doing even worse. Their NPL ratio, I think, is like record highs. Revenue also dropped, right? And also net profit also did plunge 100%, and now it's in negative. They're losing money, basically. So just I think it's quite clear cut why the share price has been dropping and haven't been doing well. One more. Wait, let me just check if I got one more question. Yeah, okay, I think that's all for me. Maybe let me hand it over to the rest of my colleagues so they can answer the rest. Thanks.
Yeah, thanks, Glenn. Take on some questions. First one is on which stock. Sorry. There's a question: which stocks benefit from Trump investment accounts? Yeah. So I went to briefly search it out. I think it's the I think Trump, the federal government directly approached the asset managers, the huge ones, for example, like State Street, BlackRock, and Vanguard. So these will be the asset managers who may be a beneficiary. Or maybe you can also look at the stocks with a high percentage of these institutional investors. For example, like the big tech stocks from the Mag 7, like Microsoft, Apple, Nvidia. Or else you can also look at defense, like for example, the huge defense stocks like Raytheon, Lockheed Martin. Even though we don't cover defense, yeah. So these is just some potential angles to look at. Yeah. What's the valuations of SK Hynix versus Micron? Yeah, so after the recent pullback, Micron's forward PE is about 14 times. SK Hynix is about 7 to 8 times forward PE. Yeah, so I believe the discount in valuations for SK Hynix as compared to Micron is because of the liquidity situation, because Micron is listed in the US market and SK Hynix is only in the Korean market. So that's why they are trying to pursue this Nasdaq listing. Yeah. Which will potentially increase the valuations for SK Hynix. Yeah. Why is Evergrande seeking a Hong Kong dual listing? How will it impact the SG listed counter? Yeah, so I had a brief call with management. They wanted to have to seek this Hong Kong dual listing because they want to see whether they can have any further links with China itself, whether there could be any potential M&A opportunities over there. So they want to I mean it's a exploratory stage, so now it's still a very early stage, but it could be possible that they may find a good M&A there and explore in the future. Yeah. So and also because Hong Kong stock market is also doing quite well recently, so there may be a slight valuation premium over there. Yeah. So that's why they are seeking this Hong Kong dual listing. How will it impact the SG listed counter? In terms of the valuation premium, there could be a slight bump. Yeah, but I wouldn't say it's material at this point in time. Yeah. There's a question: is Supermicro a stock to avoid? We don't cover Supermicro, but personally, I think there's a lot of red flags in the stock itself. For example, their auditor, EY, recently resigned last year, I think, and also this year they are also under scrutiny from the Taiwanese government. Because of some corruption issue from its staff, and also Nvidia also criticized the company because they were accused of smuggling chips into China. So I think there's a lot of red flags for this counter. Yeah, I would say it's a stock to avoid, unless you have a very strong contrarian view regarding this. Yeah. What is your view on Tiongwon's prospect in the short to medium term outlook? Yeah, so regarding Tiongwon stock, we also don't cover, but just to give a bit of my view, I think recently their stock has been sideways, And also I find it quite correlated to the swings in the oil prices. The diesel prices has been impacting the entire construction sector stock recently. So in the very, very short term, I feel that if there's any fluctuations in diesel prices, it could affect the stock price movement for Dongwon. But however, diesel only make up about 5% of Dongwon's cost of goods sold. So technically the impact wouldn't be material in terms of the diesel impact. And going forward, I think because this year is the year of construction projects getting executed, and we think that Dongwon would be able to be a beneficiary of this increase in construction volume from their heavy lift and haulage operations. Yeah. Yeah, okay. I think I can hand over the time to my other colleagues. Yeah, thanks.
Perhaps I can take one question on how is the latest non-farm payroll signal the US economic growth is not that strong after all. So I think I wouldn't conclude the US economic strong growth is weakening just from the latest non-farm payroll reports. So I would say the payroll data suggests that the labor market is not overheating, which reduce the needs for Fed to hire in the near term. And we can see other indicators still points to a fairly resilient economy. For example, the retail sales remain strong and consumers still spending. So for context, we can see the 2-year yield ended the week higher at 4.14%, up 5 bips week over week. But it was lower than the 4.18% level since before the payroll release. And moving to 10-year and 30 years, we can see the yield actually rose more by around 11 to 12 bips to 4.49 and 4.99%. So moving forward, we expect the 2-year yield to stay capped, while longer yield will continue to stay precious by inflations and term premium. Yeah, that's all from me. I will hand it over to Ado.
Yeah, thanks, Sui. Let me run through some. What's your view on the white cent investment for FCT? Yeah, so this investment is actually not new news because it's been on the market for quite a bit. So now that they've actually finally managed to sell that at a good deal, 8.4% above valuation, about 4.5, 4.6% as it yield. So we think that's attractive deal. So now they can use this proceeds to pay down some of the higher cost debt. Yeah, so we view this deal positively. Is the outlook for SG Office REITs good currently? Yeah, so the outlook for SG Office is actually quite strong, mainly because of the fact that there is basically no new supply coming in the core CBD region. So let's say the Marina Bay, MBFC, that area, the rents are looking very strong. So we're looking at a high single-digit positive rent reversion. So the outlook is actually quite strong for for Singapore office REITs. Yeah, the demand is or rather is mainly backed by the fact that the demand supply dynamics is still in the favor of the landlords because of the very limited supply. The market seems to favor AIMS over Stonework and Elite despite the latter having higher yields. What's your view on them ever to catch up? Yeah, so I believe you're asking more on the share price performance because recently, so far year to date, I believe AIMS APAC REIT, the share price year to date has performed very well. I believe it's up 9% or close to, if you look quarter on quarter, is probably up over 15%. So it's really performed well compared to Stonework and Elite. The share price has not moved as much. I believe Stonework is kind of flattish. Elite as well. Yeah. So going forward, our house stance is still we favor this high yielding place. But regarding your question, whether we can catch up with AIMS, yeah, we think in the near term to catch up 20% upside. Yeah, it is possible, but the sentiment really has to change because like for Stonered, for instance, the ECB is raising rates, so the market sentiment might take a while before the fund flow start to flow back into some of these REITs in our view. But generally we favor them because of the high yield. Like while you wait for the recovery in the share prices, yeah, we are looking at 8.5%, 9% yield. So we think that is attractive. Yeah, so hope that answers the question. Is PropNex having a limited growth for this year? Yeah, try to answer this question. PropNex is covered by Paul. Yeah, so for PropNex, basically this year, because last year was really stellar year, they had like 11,000 over launches. As compared to this year there are fewer launches. So we are looking at around 8,000 to 9,000 launches. So from that perspective, we are possibly looking at a year of consolidation for PropNex. So I wouldn't really say limited growth, but just because of the number of launches, so that the revenue might be impacted a little bit from the fact that this year that there are fewer private residential new launches for them. Yeah, but we still have an accumulate call for PropNex. Why is Keppel REIT share price getting weaker? Yeah, I think Keppel REIT, after they did that equity fundraise last year for the acquisition of NBFC Tower 3, yeah, the share price has not really been performing that great. It likely will take a while before because of the sheer amount of funds that were raised. There was a share price overhang, so possibly it's still dragged on to now. Yeah, but operations for Keppel REIT has been quite strong, like rent reversions in the double digits, especially for Singapore. Yeah, so operations wise, Keppel REIT is still performing very resilient, but the impact was mainly, our view is from the share price overhang from the dilutive fundraise that they did. Yeah. Okay, I'll hand over to my colleagues.
Yeah, I can take a few questions. So is fuel cost not a concern for SIA since oil price has fallen back to pre-war levels? At the moment, prices, yes, are back to pre-war levels, but we think it's going to take time for volumes to normalize because there could be a lag time, and that's something we are looking out for. And for SIA in specific, I think their main drag is not so much fuel costs, but rather their Air India associate. So until Air India becomes profitable, then there is always going to be a drag on their earnings. And if there's a drag on their earnings, then we think that it will be difficult for SIA to re-rate. CNMC past two sessions came up. Any reason? Will it continue to target price? So I think as Tse Yi pointed out, the non-farm payroll came in lower than expected. So the likelihood of your interest rate hike is lower. So comparatively, that would mean gold is going to do well historically. So that was one of the main reasons why we saw over 10% rise in CNMC's share price. On whether it will continue to target price, it depends on where gold price is going to be at the end of the year. If you saw the report came out by World Report Council, they are targeting about $4,500 in gold price by the end of the year. And that would mean there is still some room for gold to run. And CNMC is a leverage bet on gold. So it is going to track closely with gold prices. But CNMC specific, they receive in principle approval for main board listing. So that was one of the latest news. And that can improve their liquidity. And if their liquidity is improved, maybe we would see more institutional interest. So that's something to look out for also. Next, hi Hashim, can ultra green stock analysis be uploaded on Poems? So I went to take a look. I do see the initiation. I think it's listed under US country because IT probably put it because the stock trades in USD. But yeah, I can go and feedback to them. Yeah. So I think that's all, and I'll pass on to.
Yeah, just to address one question regarding Guthrie Engineering. I believe the question says he believes Guthrie Engineering CEO was previously censored or banned by MAS. What is your view on this? Yeah, so Guthrie Engineering, just to clarify, Guthrie Engineering CEO wasn't previously censored or banned by MAS. His name is Alan Tay. I think you may have been confused by the Alan Tay from CIMB Bank, the former vice president. Yeah, so the Alan Tay from CIMB was banned by MAS. It's a totally different Alan Tay from Guthrie Engineering. Yeah. Hope that clarifies. Thanks.
Thanks, Sigban. I can take on some of the TA questions. Yeah, so first off, starting off with PropNex. So I think for PropNex generally, I think in terms of the current trend, we're still seeing a pretty much range bound kind of price action that's been taking place since April or May. In terms of, if you look at the Bollinger Bands, also quite flattish. So I think for now, there's some general support around 183, 184, this level where the price, I think this day, on 19 June, there was a huge volume rally day afterwards. So I think these previous reasons will likely hold some support for now. Then in terms of current reason, I think it's about 189 to about 190, 194 this area. It's the recent high as well as the Bollinger Band area. So I think generally we'll still likely see some kind of sideways movement for now for PropNex. Yeah, then next one on CNMC Gold Mine. For CNMC Gold Mine, some rebound recently, but I think generally likely be a bit kind of still in a bit of kind of still seeing some weakness as well as I think some sideways consolidation with the resistance with this area. I think currently about 126 to 133. This area previously was a support. So after the breakdown over here during the retest window of June, became resistance. And I think for now it will still likely hold at some reason. I feel when price, if it hits the upper Bollinger Band at 130, I think there's some resistance. And then currently for support, I think will likely be around like 119 to 123 this area. Okay. Maybe wait for the moving averages to catch up as well. As these past 2 days, there's been a bit of a strong jump in terms of the share price. So I think we'll still be quite sideways for now. Yeah, then for micro, I think some slight weakness in terms of the very short term. With price, I think after the results, I think there was this short-term double top at this 1,210 level. Afterwards, we see some weakness, especially on Wednesday last week, where price is below the 5 and 10-day SMA levels, as well as the 20 SMA, as well as this hour support line as well. And I think this was like the previously price also tested this yellow line, which is the 20 SMA level a few times when there was some breakdown. So some short-term weakness. I think over here there's still some support at this region of 950 to about 1,000 over here. So we could see some bounce, but I think retest could face some resistance as well, which is like above, I think 1,040 to about 1,010 area. I think would be some slight resistances. Then you could see some kind of a sideways movement. Next one on the SOXL, which is the 3 times bull semicon ETF. Yeah, so for the SOXL, I think some weakness as well with I think with the SOX forming some weakness. Yeah, so some I think currently we are seeing some breakdown in terms of the short term this hour support line, and I think support will come in about this 135 to 157 if we test this level. Then some resistance for now, I think it will be above like 200 to about 220. I think that will be the short term resistance. So probably we'll see a retest, then you find some resistance, then maybe some sideways. If we look at the stocks index, the Philadelphia Semiconductor Index, also some weakness for now. Previously, I think this 14,000 level, there was this potential bullish trend in near term, and afterwards, this has continued to act as resistance at 14,000, and also the price broke down this our support line on Thursday. So I think for now, some possible short-term weakness where this 13,100 level onwards will likely be some short-term resistance, and then price will likely still find support. I think from this, if it tests like 12,000 to 12,200 this area, I think we'll still hold some support. So probably some sideways with some slight weakness in the short term. And then for Walmart, I think probably we'll see some sort of a rebound, but still some weakness. I think there was a gap down on Wednesday to retest of these previous levels at 109, 110, and then some rebound at end of it. So I think for now we could see a retest of the 113 level, 113 to 115 will likely be the resistance area for now. Yeah, then afterwards might do some slight pullback and move sideways. Yeah, since about stock is at the hit about close to the oversold level on the RSI 25. Next one on the IGV, I think some rebound over the past week. So I think for now, hit one resistance level, which is like this 93.60 to about 94.70 area. So stock, yeah, there was some upper weeks for the past 2 trading sessions and consolidated sideways. But I think overall, we could still see some this rebound hold as long as it doesn't break below the 5 SMA level, which is $91 for it. So I think we'll see some side consolidation, and then if you can break above this 95 level, then there could be some further bounce to test about 99 as the next key resistance level for the IGV. In terms of the triple Qs, I think general trend we're seeing is just very range bound market. So after a short rally from March, I think it's quite normal that we're seeing some consolidation that has been generally started since beginning of June. So I think we're still likely to see some kind of this consolidation as long as the key levels at is about 690 to 700 does not break below that. I think will be still okay, just a normal sideways consolidation. Yeah, and then price also retested the 50 SMA recently, so still holding some support over here. And then I think some temporary resistance will probably be around 720 onwards. And then you can see the 5, 10, and 20 SMA levels also kind of converge right now. So price is just moving sideways. Next one for NVIDIA. Yeah, for NVIDIA, I think for now, I think price is doing some sideways movement. So I think for now, the resistance is this $199, $200 level following a breakdown, and then the retest of the 10 SMA level as well. So I think that's the current resistance. I think support will likely still hold is 190 level over here. So I think will be pretty much kind of range bound that we're still likely to see. And also given that previously there was some strong resistance over there in the past. For example, in February this year, 190. So I think this will be still support for the near term. So about 190 to 200 consolidation right now. Next one for IX Biopharma, I think price action wise also very range bound for now. We are seeing in terms of the price action, I think these 39 cents to 40.5 cents for now will likely be some resistance. Then for now, I think price has remained holding support at the 36 cents, 37 cents area. So just very range bound kind of price action right now. Next one for Bumi Tama, I think also quite sideways. After the stock we tested this 180 previous support level, there was a pullback, and then volume has also dropped off, and then just moving sideways over here. Strong support is about 163, also so some support at 168 right now, which is also the 5 and 10 SMA levels as well. So I think price was kind of move sideways. Bollinger Band is also flat with resistance at about 180. Next one for Franken, there's some short-term weakness where price is currently under this upper support line. So this line, this is the support since March this year, and then after that, previously price formed like a double top at 352 pullback. There was some support along here, but there was a breakdown, I think Thursday last week. So I think shorter wise, there's still some support still holding at this 286 level. Then price is quite sideways, resistance 297 to about 303 right now. So I think some sideways movement. By price below 286, we might see a retest of this next support level here about 276. Okay. Then I think that will still hold the price. So I think just probably some sideways movement, but with some weakness in the short term. On the weekly chart, I think currently is below the 5 and 10 SMEs of the weekly as well. I think for UMS is kind of something similar as well. Yeah, so for UMS also recently it's just a retest of this previous breakdown level, about 270s about there is holding its recent, and then support is still coming at the recent levels about 254. So some sideways movement resistance, I think for now is $2.62 to about $2.65 this gap area, and then so I think we'll be still pretty range bound for now. On the weekly, it's also just hanging around the 5 and 10 SMEs. Next one on First Resources. So for First Resources, I think price is still in the short term wise, I think still moving up nicely. Overall, for now, are seeing higher highs and higher lows, and also the lows holding the previous breakout levels. So recently there was I think last week there was a breakout this $3.24 level. I think this is where the 5 SMA currently is as well. I think this will be quite a good support for now. Then the next upside resistance for now temporarily is closer to about 350, which is this breakdown level over here. And also close to the upper Bollinger Band level. So I think could be still seeing some kind of this steady upwards movement, but with some sideways movement along the way. Whenever we tend to see some hours move, and then price will do some sideways after a while. Next one for Geo Energy, I think price also still just moving up steadily for now since after the break of this descending triangle pattern over here. Last week I think price retested this 50 cents this swing high resistance level and held steady. So I think this will be the support right now. Some small resistance I think for now is at 53 cents. So there could be some sideways movement over here for now, but I think generally supported along the 5 SMA level and so as 50 cents. Then I think afterwards, I think it could still go higher to test about the 56 cents level as a key resistance for Geo Energy. Then for SIA, I think generally it's still very steady steady price action that we're seeing right now. So for now I think it's just some sideways movement, consolidation, and volume is declining. So I think it's just awaiting the next direction. I think we'll still likely to see some upside as long as it breaks above 770. I think the next resistance will probably be about $8. So it's still quite a steady upwards movement right now. Next one on UOB KKN, I think for UOB KKN, I think generally it's still uptrend counter. And the key supports to look at will be this upward support line that's been holding the price. Generally a bit of a sideways movement right now, and the key support over here at 360 needs to hold as it's moving range bound right now. Yeah, then today I think we tested this swing high about $4, but I saw some slight pullback, also the upper Bollinger Band level. So we could see some slight pullback over here to retest the 5 SMA level, and then for some support. So that could be about 380s, about 386, be some support over there for now. So I think for now sideways, unless it can break above 420, then the next resistance will be about 415 about that. Okay, next one is on Ultra Green. Yeah, so for Ultra Green, I think generally price is still generally see some weakness with some lower highs along the way, but recently the pullback I think over here is still holding this recent swing low. So transitioning more towards a kind of, I feel it's kind of more sideways price movement. So I think for now we are likely to see some resistance. The key resistance is about 132, 133, this recent breakdown level at the end of June, and then the 20 SMA level. But I think price will hold possibly hold a higher low for now. It's about 125 to 127. So kind of sideways movement for now. Then I think the key for the stock to really get out of this weakness right now is to try to break out this downwards resistance line and also hold the higher lows over here. So I think let Paul take some of the question. I think he's in the seminar. Yeah.
Oh, yeah, I think it's okay. I can type it out. Yeah.
Okay.
Yeah,
thanks,
you can go ahead. Yeah, Zin. Yeah, thanks. Sorry
Okay.
to interrupt.
Yeah, next one is the Ping An SDR. Yeah, so for the Ping An SDR, I think generally for this is generally quite low volume. Then generally I think what I'm seeing is kind of sideways movement that's taking place right now. So I think some of the key levels is that is recently we tested was about $4.20 to $4.30 this area. Previously was a resistance, and then price holding support over here. So I think for now we could see some kind of range bound action with key resistance about 455 455 to about 465 area as the next key reasons. I think so kind of some probably some sideways actions, which has been the case since I think start of this year, generating this big range sideways movement. Yeah, next for the BYD SDR, generally I think still very weak, still very quite downtrend overall. Recently has been seeing some rebound. But I think let's see where's the in terms of the key reason, I think $1.44, I think that will be quite a key reasons, where it's the weekly 10 SMA level. And as well as this, it was this key support breakdown level. So that will represent a retest. Then for now, I think there are some indecision right now at 138, 139 this level. So some temporary resistance over here. Then I think support for now will be about 134 over here this level. So after 2 days, 2 days of sharp rally, we could see some sideways movement for all this. Yeah. And then there's a question on Nebius. Yeah, so for Nebius, I think last week also start to see some weakness coming out, I think, with a breakdown of this upper support line about at $234. And then so I think for now we could see some near-term weakness. I think support will, if it tests this level at around 200, this swing low and lower Bollinger Band, I think that could still hold as the support. Then right now, I think resistance is generally 234 to about 250 area. I think that will be the resistance. The next one, back to some Singapore counters. First one, Singtel. I think overall still very sideways. But I think still doing okay. I think it's a 448. Still this key reasons to crack. Above that, I think we could see about 455. It's the next resistance level. But then for now, I think it's still holding some key levels. Is 442 as well as at least holding the 10 SMA daily. So it's inching up, I feel, and a bit sideways. So I think that's what we can expect in the near term, with some still very much sideways movement. Next on sets. Yeah, for sets, I think some slight pullback last week with the on Friday, where price is running below this 10 SMA level and also 445 level as well. So some slight weakness after this strong rally you're seeing. But I think we could see price kind of transition into a kind of range bound movement. I think supports overall at $4.30, and that will still likely hold the price, where that's currently the 20 SMA level as well. So currently some resistance, I think it's about 446, 445, 446 onwards. Then we could see some sideways movement. Yeah. Then also I think weekly chart wise, I think the support is still at 433, which is a 5 SMA level. So there's some pullback after the very strong rally recently. Yeah, next one for SI Engineering, I think it's just still kind of sideways movement. Good positive thing is still holding the 338 this breakout level, and then price is just moving sideways after this high volume day and the rally with support around 343. I think reasons for now generally is about 353. Then above that could be 360 as the next key level. So I think I will still expect some sideways movement. Yeah, but I still holding the key levels for now. The next one for Centurion, I think. Yeah, for Centurion, I think price action wise, pretty much kind of range bound that we are seeing overall. Yeah, so you can see for the Bollinger Band levels, it's very flat. So the key resistance, I think for now is about 152, 153, which is the upper Bollinger Band area, and also the recent swing highs end of May as well as middle of June. And then I think support will likely still hold about 145, 147, this area right now. So I think you can expect some kind of sideways movement to continue. Next one on ST Engineering. Yeah, for ST Engineering, I think nothing much. Just overall, it's still an uptrend. Then we are seeing quite a long sideways movement taking place right here. So general support about 1040, and then resistance comes in about $11.10 onwards. So I think nothing too much for now. It's just still this range consolidation that's been taking place since the start of March. Okay, then next one I'll move on to the STI as well as the three local banks. Yeah, so for STI, I think general trend is still very healthy uptrend and very steady as well. Yeah, since the price broke above this 5,040 level, and then I think the key is this blue line that's holding the rally. So this is our support line since September last year, and that has not been reached. If you pull out some of the midterm moving averages, the price has also held the 50 and 100 SMEs doing some consolidation pullbacks as well. So it's still very healthy rally. I think right now it's just some sideways movement recently. Yeah, today retested the 5,240 level. So could expect some pullback over here, but I think support for now will be about 5,200. I think there will be a good support. Then if it's a breakthrough of this 5,250 level, then I think we could see some highs for the uptrend for you to test about 5,300 next. Yeah, so in terms of the banks, first one, DBS, I think right now we are seeing range consolidation, but still holding, still a very steady rally. We hold with some pullbacks holding above the previous breakout level. So this 65.19 level still holding as support. Then some recent, I think for now 67. So I think just kind of sideways movement right now. Yeah, then for UOB, I think yeah, still doing quite well after the sideways movement at least $40. I think price inch higher. So I think could still see some possibly price to appreciate further to if it tests upper Bollinger Band, it's about $40.80 as the next key level. Yeah, but overall it's still a very steady rally. Yeah, and then for OCBC, another retest of this $25.30 level. So I think for now support should be about 25. I think over here should be quite a good support. Where there's currently the 5 and 10 SMA levels over there as well. And then this sideways consolidation also held above the previous swing high resistance about 24.50. So overall still very steady uptrend. Yeah. So the banks, the price action is kind of similar to the index as well. Okay, next one for venture, I think right now some weakness in terms of the share price. We are seeing lower lows, I think, since this swing high on 7 May. And then I think today possibly breakdown of this support about $17, and last week was about this like lower high range bound movement between $17 about 17.45. So I think some weakness in terms of the short term since start of May. So I think possibly you could see some weakness further towards to fill this gap over here about $16.70 about it. So I think this could hold as some support, and we might see price do a bit of a rebound to retest about 17 again, then some sideways afterwards. Next one for Semco Industries, I think overall, still some weakness. Still some weakness for now. With a breakdown, I think of the support at this $6, also with increasing volume as well. So today, I think tested the next key level about $5.80. The next one afterwards was $5.65. So I think the price action kind of similar to a few times in the past. I think we have seen this before with Semco Industry previously, that I think for price to stabilize, we need to see the candles getting smaller and then start to move a bit sideways with decreasing volume as well. So previously there was like one in February this year, then also another one I think in August last year as well. Yeah, so I think for now there could be still some weakness in terms of the share price until we see the volume comes lower and then price action start to form a bit more sideways. The next one on Food Empire, I think generally is very range bound since the trend has been bad since end of February this year. And I think recently still holding the key supports over here, 235 as key supports. Then today a retest of this swing high, so I will expect some recent at 254. Also double Bollinger Band areas also. So possibly some pullback around here, then support is about 244, 245. This 5 SMA level as well as this horizontal level. So we'll see some sideways movement for the time being, right? Then above that, there's also the next key resistance, I think, will be about 260 to 262 area. The next one on Intel. So for Intel, I think price action generally still sideways, but some potential bearish divergence on the momentum indicators where price made a higher high. So and then the momentum indicators are making a lower high. So I think the key is this support at 118 must really hold. So this is a range bound price action. 118, if 118 gives way, then we are likely to see some further downside with the momentum coming off as well. So the next support below that will be 112 and then 105. Yeah, so for now, I think the resistance I think will likely be about 126 to 130 area, which was the breakdown level, this level as well as the 130 you have the 10 SMA level. So I think this will be the current resistance. Then support is about 118. That is quite important to hold. Yeah, on the weekly chart, we can see the importance as well. During the rally, I think since March, price on the weekly time frame has been holding at least the 10 SMA. So this has been tested twice. That has still holding above it. So if price is below that, we'll likely open the room for some further weakness. So the 118 level is quite important. Next one on AEM. So for AEM, I think generally right now, I think some weakness in terms of momentum as price is also bearish divergence where price form a bit of higher high and then momentum is coming off. So I think right now we are more likely to see some range bound price action take place. Last week we saw price retesting this like $11 level and then some pullbacks taking place. So I think we'll likely see some sideways movement. 965, I think that will still be the support that holds the price, I think, in the short term. Then I think generally resistance like above 1050 onwards. So I think pretty much range bound price action. Next one on CDL. Yeah, so for CDL, I think I feel that we're likely to see some sideways movement. Recently there was this rebound to retest this 790 breakdown level. So some resistance came in today, but I think for now support is about there's some support about 775 this level as first support level, and the next one is about 765 the lowest last week. So I think generally we'll see some sideways movement take place kind of right now first. Yeah, then for Yangzijiang Shipbuilding, yeah, for now I think still I think generally what the trend in the short term still kind of range bound since if you're looking at from the start of June, previously price I think from up upper top and then pull back. So for now it's moving sideways. So first resistance right now is about 360 this level. I think this is the resistance. And then afterwards about 370 and then this swing higher. So for now I think kind of sideways support will likely be around 375, sorry, 347, yeah, about thereabout. I think we'll see some kind of sideways movement. Yeah, yeah. Next one on CICT, I think generally still quite a range bound. I think yeah, recently I think in terms of look at other Bollinger Bands, currently 242, I think that will be the recent as well as the recent swing high. Support for now, there's some support at 237. That's first level support where there's the 5 and 10 cm levels, also horizontal level. Below that is about 235 as the next support level. So I think these are the price will likely move some sideways generally between 235 to 243, I feel. Yeah. Okay, I think there's two more questions. I'll finish up. For Hong Leong Asia, yeah, Hong Leong Asia, I think in terms of the price action, there's still some weakness. Previously, when price, I think tried to break out 350, it wasn't unable to sustain, and then the retest here found reason. So that's weakness. Afterwards, we have seen the weakness in terms of price action since the middle of May, below highs, lower lows, and then price breaking below some support levels as well. Like recently at 287. So it's back to retest this 263, which is quite important as well. So generally still some weakness as price is below the 5 cm level 268. So I think there could be still some room for some downside if this 263 fails to hold. Yeah, then the next I think the next support probably will be around like 250 as the next support for Hong Leong Asia. Okay, next one, I'll take one more on SGX. Yeah, so for SGX, I think generally it's still it's in terms of our third quarter strategy, it was for the technical outlook, I think it still looks good in terms of the large caps, amongst the large caps. Yeah, so in terms of the price action, I think as mentioned earlier, for now it's still in this bullish track over here, 2360 to 2450, and also the 20 SMA level could be a support as well that we've seen in May, end of May, start of June this year. So just some sideways movement. Yeah, then I think if price can do a close and also break above this 2450, then I think there's still potential for the rally to continue. Yeah, so for right now, I think it's just moving a sideways consolidation, especially after this sharp rally that we seen 11 June to 18 June. Yeah. So I think it's good. I think I managed to take all the TA questions. I think I'll hand back time to my colleagues or Paul if there are any more comments. Thanks.
You want to take the AEM question?
Yeah, sorry. The question is for AEM, any further upside from the current price, or is it already overpriced? I think in comparison to its peers average, which is SGX listed semicon companies, AEM is slightly on the premium side. But I think this year itself, we do still see further catalysts going forward. For example, because its biggest customer is Intel, so with the potential listing of Anthropic and OpenAI IPO on the Nasdaq, we do see them as a catalyst for Intel, and in turn, there may be better sentiments on AEM as well. Yeah, thanks.
There's one question on Tianjin Pharmaceutical. Apologies that we don't really cover that, so I can't don't really look at it closely. Yeah, thanks. I think we did hit one. So thanks everyone. Apologies I couldn't attend the earlier session. Had another meeting. With that, thank you everybody for your time, and thanks so much for taking the time to join us and ask, especially for all your questions. Thank you everybody. Take care and have a good week ahead. Bye bye.